Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Tracy Reinick, Senior Equity Strategist at Zacks. We are talking about the housing markets, which have been booming in the aftermath of the pandemic. And Tracy has been bullish on housing for quite some time. She's a housing expert, and she has called it Housing Mania of 2020. And she has been right. So we'll talk about the housing markets, and we'll also talk about some of the best stocks and ETFs to profit from this mania. Tracy, welcome, and thanks for joining us.
Well, thanks for having me, Nina. And I love talking about this topic, so I was very excited to be asked to be on the podcast this week.
Sure, let's do it. So housing numbers have been pretty strong in recent months, and this is mainly due to migration that we are witnessing from urban centers to suburbs because of this work from anywhere environment, record low mortgage rates, and plus housing inventory has been quite low. So let's start with the demand. Why have we seen this surge in demand? Is it mainly because of millennials leaving urban centers, their expensive tiny apartments in areas like San Francisco, Manhattan, and buying houses in the suburbs? And also talk a little bit about which market areas have seen maximum impact.
Yeah, so it's kind of a convolution of all the factors hitting at one time. So we've had the millennials, getting older, so to speak. That old phrase of like, oh, the millennials are in their parents' basement, that's now 10 years old. So a lot of them have left the basement many years ago. And as you said, we're living in apartments in the cities mostly. And we're kind of waiting to see what they were going to do about household formations. They're getting married later, the latest of any generation in the last 120 years. So as we're waiting, now a big chunk of them are getting to that marriage age. They're having families, and then they were in these apartments, and then the pandemic struck. So you have that issue of, hey, we're starting families now, and we're stuck in these apartments, and now we want to get out of them, as you mentioned already, and buy a house. Now, many of them can't afford houses in the cities they live in because the housing costs in those cities, so they have been going out to the suburbs where your money just goes farther. Also, because of the pandemic, they want more space, especially outdoor space, and they want to be able to, go into the backyard or whatnot. And so those factors are all in play. And then you have the factors of the baby boomers actually as well, who were in their old neighborhoods. And many of them are now retiring and wanting to move to new states, a lot into the Sun Belt. It's called the Sun Belt for the reason, right? Because they're chasing that weather. And so they are also looking to buy something new and get in another area as well. So, and they're a huge generation as well. So you have all these things, all these factors, and then putting on top of it, we had those record low mortgage rates, which you also mentioned, and suddenly it made it cheaper to buy than to rent. So that put another flame under the millennial buyers, and soon, possibly in the next couple of years, some Gen Zs. Now, I don't know if everyone remembers that Gen X basically didn't live in apartments that long when they got out of school. They mainly, because the condo boom was raging at that time in like the late 90s into the 2000s, they jumped right into home ownership in the condo area, and then many moved on to single family homes from there. But millennials have basically skipped the condo scene because of the housing bust and the sheer number of huge new buildings that went up in apartments. And so they've been holding off on buying anything. Some of them, did see what happened and the number of foreclosures and all of that. So they've been reluctant to get in. But now we have moved beyond the housing bust by a number of years. Almost a generation has moved on. And so they're not having the same kind of qualms about buying. And again, with those record low mortgage rates, it's actually pretty cheap to buy right now.
Yeah, you're right. Millennials had actually started buying a few years back. That trend started a few years back. And I recently read an article in the Wall Street Journal. It said that demand from millennials reached a housing milestone early last year when the group first accounted for more than half of all home loans. And they consistently held above that level in the first months of this year. So this is a trend which may continue beyond this pandemic too. But before that, I wanted to talk about the trends seen in some of the metro areas. And in a recent presentation, you highlighted some very interesting numbers from New York City region and Bay Area and also Chicago city area. So talk to us about those trends that you have seen.
Yeah. Mainly, as you mentioned earlier, a lot of people are rushing out of the city centers to the suburbs. So you're seeing strong sales in existing homes in the suburbs, wherever they can find those. But where they're building the new homes, that's also seeing, just decade high sales for the new homes as well. But people don't really want to wait, because a lot of times with new home build, they haven't started building it yet. It depends on what their inventory is like, but you might have to wait a year to get in there. So that's why the existing home sales have been so strong in these suburban areas. So again, they want outdoor space, and they're just fleeing the cities and the prices in the cities to go out to those suburban areas. Now, we are seeing like super strong sales in New Jersey, in Connecticut, outside of New York City, and then all of the surrounding suburbs. But even the further out suburbs of Chicago, which we haven't seen for a long time, all the way out into, Will and Lake counties out in the far suburbs. And then to some extent also in California, although if they're priced out of the Bay Area suburbs, they're heading to Sacramento, where the home prices are cheaper. And there is some new builds also that are cheaper happening in the Sacramento area. But a couple of really key hot areas are in the mountain areas that you're seeing a lot of Californians move to. Sorry for those other states. But Boise, Idaho is one of the hottest markets. And then Montana, the Washington Post just had an article about Montana's housing market and how home prices there in the top 4 largest cities are up double digits. And I looked around to see what home builders are in Montana, because I've heard a lot of them talking about Idaho, but not Montana. And I was like, is anyone even out in Montana? And I couldn't find anybody with actual developments in Montana. So that's a local market with the local home builders. So they must be doing pretty well right now. But anywhere in the mountain areas, and then in the Sun Belt again, in Texas and Florida are probably the 2 other super hot markets, as well as the Atlanta and the suburbs of Atlanta.
Very interesting. So obviously, if you can work from anywhere, you don't have to be in suburbs. You can be near the mountains, or
right.
you can be in beach towns. So definitely very interesting trends. So another reason for particularly for increase in prices is that inventory is at historical lows. There are more buyers than properties on the market. So why is the inventory level so low for housing?
Well, that's been the case for several years. So that was even true pre-COVID and pre the record low mortgage rates, because the housing bust basically put a lot of caution into the industry. So the new home builders, were being more conservative with what they were building. And then even with the existing inventory, you just didn't have people moving as often. Home prices were not, skyrocketing higher depending on where you are. If you were in California, you had other issues. You were seeing skyrocketing, but in the large parts of the country, it just wasn't, increasing enough where people were willing to move. So the inventory just has kept dropping over the last couple of years. And now we are seeing, as you said, at this record low for the existing home sales. And some of those in certain cities are among the lowest I've ever seen. Like in Chicago, the single family home inventory is only 2.8 months, and anything under 6 is a seller's market. And anything under 3, I mean, that's almost nothing is on the market when you're at 2.8 months. So yeah, we're seeing a lot of pressure that's going to put pressure on the home prices with that low inventory. And the builders, there's low inventory in the new home market as well, but they are still being cautious, which, Wall Street likes to see. They don't want to see overbuilding either. And the home builders have learned a lot of lessons over the last 10 years. So they're keeping it pretty slim here. They are buying more land and they are opening up new communities, but not at the pace we saw during the housing boom years, not anywhere close to that. So that's keeping some pressure on prices, actually, because several of the home builders have talked about how they do have pricing power and they're able to raise prices right now. They've been raising in some cases weekly, depending on what the sales are like. So they're really testing that higher limit and where the home buyers, say no, or where they move forward based on even just weekly sales. So that's something to watch going forward, because we don't really want housing prices to overheat again here. So
Right.
We want it to be strong, but not, crazy like we saw, in the boom years.
So do you think that some of these trends would continue even after the health crisis is over? Because hopefully we will get one vaccine by the end of this year, and probably 1 or 2 or 3 vaccines would be available for general population by the second quarter of next year. So do you think people will start coming back to the cities once the pandemic is over, or the housing may continue to be strong even after this, because many companies have already announced remote work, flexible work, or work from home forever policies?
Yeah, that's something a lot of people are debating right now. I do think people will return to the cities after the pandemic. And even with work from home, because of the amenities that the cities provide, in restaurants, entertainment, sports, all of those things, international airports, shopping. So I still think the demand will be there on the city side. It's unclear if people will return and buy condominiums and homes, if they'll want to be renting again. We have seen in the past big turns in the markets where there's simply too many apartments, and that those are then converted over into condos to meet condo demand. So that could happen because, again, Gen Z they're in, some of them are in college now for the Gen Zs, and that generation is actually larger than the millennial generation. So if some of them are graduating out into the world of adulthood and deciding, hey, I really do want to be in the city, the pandemic is over, I love it, and it's over, been overdone, the fears of the city, then we could see some of the Gen Z wanting to jump into that market then. So yeah, I think we're still going to see strong trends of buying in the suburbs because the millennials can still get more for their money in the suburban areas. And they're the ones who are 28 to 32 years old now, the big chunk of them. And that's when the household formation and the families and all that start happening. So that is still going to happen for the next several years. So that will still be popular. And I do think even with the work from home trend, that some millennials and then Gen Zs will choose to be in secondary cities. So there's a lot of emphasis put on, the Chicago and New York, DC, LA, and San Francisco, but some of those workers may choose to move to San Antonio or New Orleans or St. Louis or Kansas City instead, and it should boost those housing markets, which is much needed for some of those second tier cities and could be a real boost to their economies. So that's something to watch in the next couple of years.
Yeah, definitely. And as we discussed earlier, demand from millennials had been rising even before this pandemic. And that is a trend which may continue. They may continue buying homes rather than renting. Now, how's this housing market different from that in 2008? Have you been worried at all? Have you seen signs of any bubbles?
No. And that's all I'll say, because there's a lot of talk like, oh, it's getting like a bubble, because there are multiple offers on a lot of these houses, right? There's the stories out of New Jersey that there have been since the pandemic in the spring and into the summer, 40 bids on a new house in the suburbs there. But that is just supply demand dynamics with this low inventory. But there's no signs of the speculation you would need for the bubble. So as of right now, we don't have people buying multiple houses to try to, flip them for profit or that kind of thing. Same with condos, and condos are kind of on the outs now. Single family homes are in the ins because people want the more space. And one of the hottest features that people are looking for, in addition to the outdoor space, are really home offices. And that's like a trend we're going to just see while the pandemic is going on. But if you're going to end up working from home for, years, then you really want your office space to be like not the dining room table, right? Like you want your own office. So some of that is still going to go on. And so for that reason, I don't really see the bubble happening anywhere. Even in like the Californias, yes, the prices are elevated, but the inventory remains pretty tight. So that's the key to watching for the bubble in housing. Watch the inventory and see what goes on there. If you start seeing inventory expanding, then and with prices still going up, then you can see some of what we saw in 2007, 2008 happening. But for right now, no, it's just basically supply demand dynamics, and it's a bull market in housing.
I agree with you. We haven't seen much speculation in the market. And as you mentioned, inventory is quite low. And, millions of workers have lost jobs, unfortunately,
Right.
due to this pandemic. But most of those people who lost their jobs, they are in either entertainment or travel or retail or hospitalities, restaurants, those kind of industries, which tend to, have relatively low wages. And those people, they are mostly renters, not home owners. So that is why we are not likely to see a lot of foreclosures in the current environment.
Additionally, on the foreclosure front, just one thing about that too, because I know a lot of people are thinking, oh, we're going to get a lot of the foreclosures and then I'll get a deal on a house. But part of the thing that's wrong with that theory is that a lot of the homeowners today have a decent amount of home equity. So they haven't been, even before the pandemic, tapping, taking out a home equity loan out of their house, unlike the early 2000s. So they have some home equity there, and that gives them added flexibility if they are out of work to work with the bank to refinance and or pull money out of the house in order to stay in the house. And so some of that is likely to go on. And so home equity is going to be big in terms of both foreclosures and short sales as well. So that's one thing to keep in mind if you think you're going to be getting a deal and
Sorry, bad news.
Right. Probably aren't.
That makes sense.
Yeah. And it's also going to take several years. I think people don't remember how long it took the foreclosures to work through the system. So, you will be waiting a while if you think you're going to get one too. It's going to take a couple of years. But that being said, I would watch a couple of the big hospitality like areas that you were mentioning. So Las Vegas, the unemployment rate there is like 15% still because of all the jobs that are in the most impacted industries. So you're going to see a little more, issues with the housing market probably in a place like that.
Makes a lot of sense. So now let's talk about some of the stocks and ETFs that investors should look at to profit from these trends. So let's start with home builders first. And you like Lennar and Toll Brothers.
Yeah.
Both are currently Zacks rank number one strong buy stocks. Tell us why you like them.
Okay, so you could basically buy almost any of the publicly traded home builders right now. That's the thing that's so strong in this industry is that they're all seeing benefits. So some of it is just based on where the home builder is, how the management is handling the demand, inventory, and gross margin growth and all of that, their cost structure, and what markets they're targeting. So Lennar, that's ticker LEN, they are one of the biggest of the home builders. So they're in 21 states, they're in 76 markets. You probably heard of them at some point because they are everywhere. And so if you want just like a home builder that's covering, a ton of markets, then one like Lennar is one to look at. They also pay a dividend. It's yielding 1.2% right now, but the shares are still cheap. They're trading at 11 times because the earnings side of the PE continues to go up with all of these home builders because they are seeing basically record quarters right now. So the other one I like is Toll Brothers, TOL. And they're in 24 states, and they're the one I looked up to see if they were in Montana because Montana is a more upscale market for the most part, and they're not there. But that's what Toll Brothers specializes in is the luxury home market. So they do have a price point that's around $500,000. I was on their website looking around, which I really shouldn't have done because now I want to buy a new house. But I was like, wow, these are great floor plans. But they have some in around $490. I was looking at outside of Tampa, and that's their entry level, like their starter home millennial type of product, but it doesn't have to go to millennials, but they are seeing about 25% of their home purchases going to millennials now, which tracks what you were saying, Nina, about millennials being such a big part of the home buying now. But it is interesting to see them moving into the more luxury market here. But that tells you they're getting a little older now too, because luxury usually is an older buyer. But Toll Brothers, they are in the hottest areas. Like I said, they're in Boise, and that's where they're able to raise prices right now because it's so strong. But they also said anything in Texas and in like Northern Virginia and the Atlanta area is very hot. So their PE is a little bit higher. They're trading at 16 times here. They are a smaller company in general than Lennar, so not as many communities out there. They also pay a dividend, which is yielding just under 1% at 0.9%. So I like getting a little dividend with my home builders. So I like both of these because they are paying something here. Now, both are up pretty big year to date, and they're at multi-year highs. So I know a lot of people look at the charts and say, how much further can these really go? But this is, as we've discussed, a multi-year trend, and these stocks are still cheap because the E is still on the increase. So while sometimes the home builders can get a little too optimistic, you sometimes hear them say things like, this is unprecedented, and we've never seen anything like this. And some of them say, we don't see any end to the demand. But for now, that is actually correct. And this is with the millennials. They are a larger generation than the baby boomers. And the boomers mainly bought their houses in the 80s and the 90s. And so now we are seeing, a couple decades later, the same similar trends that happened back then happening again. So that's why I like any of the home builders, but these two have a little bit of niches, I should say, although Lennar is a little more on the starter home side. So I do like that area of the market, but there's, another half dozen home builders that I would also be interested in buying right now, if I could.
So as you said, when the industry is so strong, you can buy any of them. So why not buy one of the ETFs so you can get a diversified exposure to the home building industry and some related industries as well. And there are two very popular ETFs in the space. And I wanted to talk a little bit about them because they are very different from one another. So the most popular home builder ETF, it is by iShares. It's the iShares US Home Construction ETF, ticker symbol ITB. This is a market cap weighted ETF. And because of market cap weighting, it is quite top heavy. 4 holdings, DR Horton, Lennar, NVR, and Pulte Group, they account for almost 45% of the portfolio. And looking at the sub-industry exposure, home building accounts for about 66% of the portfolio, then building products about 14%, home improvement retail about 11%, and then other industries. The other big one, which is by State Street, it's State Street Spider, S&P Home Builders ETF, ticker symbol XHB. This is an equal weighted ETF, so you get a diversified exposure to many companies, and they're all held in almost equal weights. And as far as the industry exposure is concerned, that is also very different. In fact, home building accounts for just about 30% of the portfolio. Building products, about 36%, then home improvement retail about 12%, home furnishing about 8%. And even looking at the top holdings, you will see that Whirlpool and Carrier are the top holdings. It's not, then third one is Williams-Sonoma. So those related industries that have also been doing pretty well because of the boom in housing markets, you get a lot of exposure to them in this portfolio because not everyone is buying home, and particularly because inventory is so low, but people are still spending more time at their homes. They are trying to improve their homes because now home is their office too, it is the school too for their children. So they are buying more furniture, they are buying more furnishing, they are renovating their kitchen or whatever. So talking about related industries, you like some tickers in furniture and home furnishing industries. One is Herman Miller, MLHR. Tell us about this company.
Yeah, based on what you were just saying, the home furnishings has been really hot. And some of that's pandemic, and then some of it is when you buy a new home, even if you already owned one and you're moving. I mean, who doesn't buy new furniture? We all want new furniture. You got a new place, and that couch is looking kind of tired. And now with the pandemic, we're all really looking at our furniture and thinking, I need a new couch desperately. So people are buying all the home furnishings right now, as you said. So Herman Miller, people don't necessarily put it in the home furnishings category because it mainly is known for office furniture for the most part. And that's not an area you really want to be in right now because, nobody's going to the offices. People who were building out new offices or planning on it with office furniture inside there now have put all that on hold. And so their sales of office furniture have plunged. It was down 40% last quarter. But they own a couple home furnishing companies. So they own Design Within Reach, which some people know, and it's more upscale. It competes with RH, I would say. And even though it says it's within reach, it's not totally within reach for most people. But they also own Hay, Hay, that is a Scandinavian home furnishings that's a little bit lower price point. I would say it's above IKEA, below Design Within Reach, and that's been doing real well. So both Design Within Reach and Hay, those divisions were up 40% this last quarter, and their online sales were up 300% across all of their brands, as everybody, was trapped inside and wanting to buy all these new furniture. Now, they also, on the office side, and then kind of goes in with the, stay-at-home crowd, they have launched a gaming chair that's based on some of their really great design features. They're really well known at Herman Miller for having kind of cutting edge designed furniture. And so they launched this video gaming chair with Logitech, and that has been selling better than they anticipated when they initially rolled it out. So yeah, there's a lot of good things going on with Herman Miller. Now, we don't have a Zach's rank on Herman Miller, and that's because the longtime analyst on the company, who also covered Seal Case and a couple of the other office furniture companies, finally retired. And so he had been there for decades, and the brokerages they have not replaced him. But I'm hopeful that someone who's covering the Williams and Sonomas and RHs and Ethan Allen's discovers, hey, why aren't we covering Herman Miller too with this retail that they have, and that we get some coverage on it soon. But that being said, their fundamentals look good here, and they're cheap. Their PE is only 10 right here, and that puts them among the cheapest of all the furnishings, like the furniture side of the equation. And these shares are still down 17% year to date, because they're kind of like a hidden company out there. And so that is also keeping them on the cheaper side. They did reinstate their dividend that they had suspended briefly during the pandemic, and that's yielding 2.2%. So a lot of good things going on with Herman Miller right here. So yeah, I like any of the furnishings right here. And I do think that that trend is going to continue even after the pandemic is over as well.
I especially like the gaming chair. No doubt it is selling above expectations because people started video gaming. They spent a lot more time on video games during the lockdown. And once you develop a habit, you develop liking for something like video gaming, you'll probably continue gaming even after the pandemic is over. So in fact, video gaming ETFs are among the top performing ETFs this year. That's a very interesting coronavirus-driven trend that we have seen. Yeah. So another company that you like is American Woodmark, ticker symbol AMWD, and they make kitchen and bath cabinets, right? And that is, unlike Herman Miller, this has a Zach's rank, and it's a Zach's rank number 2 by ranked stock. Talk to us about that.
Yeah, this is kind of one of those hidden companies you don't hear about as much, but is a big play on what's going on out there that we've been discussing. Because they make the kitchen and the bath cabinets, they sell both to the home builders and anybody, the developers basically, and also in the retail space, like the big box retailers like the Home Depots and Lowe's. So they're able to get all the consumers right now who are remodeling, and a lot of them are remodeling right now. It's what everybody wants to do. And so they've seen big surge in demand and in sales as well. But these shares, too, are still down 16% so far year to date. They are well off their lows, but it's kind of one of those that people aren't really thinking about as getting such a big impact from what's happening in housing, but it's still cheap with the 14 PE. So I really like any of these companies that are in the ancillary businesses that are selling into Home Depot or Lowe's or any of these retailers, because as we know, Home Depot and Lowe's are killing it too. And I know some of them are all in the ETFs that you mentioned. So you can get, exposure to this entire ecosystem of the home. And it's just really something that I think we are going to continue to see. And, it was already popular before the pandemic because there's been HGTV and all those home renovation shows for years now. But sometimes it takes a couple years for the trend to really catch steam and, kind of pile onto each other. And also the consumer right now just has some extra cash. Those who have their jobs still, they, aren't doing a lot of things they used to be doing. And so they're seeing a little bit of cash in their bank account. And so they're deploying it into home renovations now. And so that's a positive for any of these companies we mentioned here. And that is a trend that probably will continue at least until the pandemic kind of ends and we get a vaccine and that kind of thing, because that's when travel and the like will return. But if you're not taking that vacation and you're doing that staycation in the backyard, well, you might buy a new pool, or you might buy some outdoor furniture, or invest in some landscaping or a backyard grill or an outdoor kitchen or whatever you can add to stay around the home. So yeah, I think some of these trends that we've mentioned are definitely going to continue, and American Woodmark, is in on that trend with the kitchens and the baths. And as the home builders remain strong, that's a big part of their business. So I don't see that slowing, not even into next year.
This was really interesting. I really enjoyed this conversation. And I'm sure we'll talk again about housing because, as you mentioned, this seems to be a multi-year trend and the industry would continue to be strong. So any of the stocks and ETFs that benefit from this trend, they are definitely worth a look. And we'll talk again maybe early next year.
Yeah, I'm all in.
Okay, thanks, Tracy. Thanks for listening. If you want to learn more about these stocks and ETFs that we discussed, please visit Zacks.com. And Tracy hosts 2 podcasts, Value Investor and Market Edge. Be sure to check out her shows. And if you like our shows, please leave us a rating on iTunes or wherever you get your podcasts. Also, make sure to subscribe so that you do not miss any episode. If you have any comments or questions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.